Many are asking, but few are answering, when is the housing market going to crash? In today's video, I'll give you the scenario and timing of when the housing market could crash. Let's get into it. Welcome to the fifth and final episode in our series on when is the housing market going to crash, and today we're going to be answering that question. As a professional economist, forecaster, and licensed real estate agent, I bring a unique skill set to YouTube that you'll be hard-pressed to find on other channels. Let's not waste any time, get straight into it. In part 2 of this series, we covered the supply side of the market, and the crash isn't going to be coming from there. Supply is just too constrained right now. In part 3, we looked at the demand side of the market and identified rising mortgage rates as the primary determinant of when the housing market could crash. And right now we are in an environment of rising mortgage rates due to the shift in monetary policy by the Federal Reserve to fight the high inflation we're seeing now. Given that, the real question is, at what point will mortgage rates be so high that it will push demand for housing down so much we see a crash in the market? Before we go further, I'm going to throw in a little disclaimer in here as we are dealing with some important information. Nothing in this video is investing advice. And although I am a licensed real estate agent, I am not your agent, and I am not your financial advisor. You are responsible for your own investing decisions. Okay, with that out of the way, here's what we're going to do in this video. I'm going to give you the answer first because hardly anyone is going to want to watch this long video through to the end. But if you want to know how I arrived at the answer, be sure to stick around to the end. In my analysis, I found that if the Federal Reserve got as aggressive as they did back in the 1980s to fight inflation, the last time they had to do so, then we could see a more than 25% drop in housing prices by the end of 2022. Yeah, it's that serious. The Fed has already raised their Fed funds rate once and indicated that more is on the way. In response, mortgage rates have already surged and are going to head higher if the Fed has to get aggressive in their interest rate hikes to fight the highest inflation we've seen in 40 years. There's a lot that could happen between now and the end of 2022, and we're going to be releasing updates as more information comes in and let you know if the timing in our scenario changes due to new data coming in over time. So make sure you're subscribed, hit that notification bell down below so you get those updates right away. If you're one of those folks who just came for the answer to the question and will be leaving now, please give this video a like and a share with others to support our channel. Help us grow so we can keep doing this research for you. For everyone else that is sticking around to hear how I arrived at this answer, here we go. When it comes to the Federal Reserve's path of rate hikes, there are a lot of guesses out there, but most people see them raising their Fed funds rate by 25 or 50 basis points at each of their remaining 6 meetings in 2022. So I built 2 scenarios to test, one where they raise the rate by 25 basis points each meeting, and another where they raise the rate by 50 basis points each meeting. And then I built a third scenario that looks back to what the Fed had to raise their rate by in order to fight the high inflation back then. That last scenario gets a bit crazy, but there is precedent for it. The last time we had inflation as bad as it is right now was in the 1980s. Back then, the Consumer Price Index peaked at 14.6% in March of 1980, and the Federal Reserve pushed their Fed funds rate all the way up to 17.6% in April of 1980 at that time to fight it. They even had to push it up higher more than a year later to keep the downward pressure on inflation. So in this historical case, they had to push their Fed fund rate up 120% of the rate of inflation. Basically, they had to overshoot it to bring it down, and they maintained their Fed funds rate higher than the rate of inflation throughout the 80s to keep it down. As of February 2022, the CPI is coming in at a 7.9% rate of inflation. So if we assume it stays there and doesn't go higher, which is pretty unlikely given what is going on in commodity markets because of the war in Ukraine, the Fed would have to push rates up to 9.5% to bring that inflation back down. So in this third scenario, I have the Fed raising their rate by 150 basis points at each of the 6 meetings to get in the neighborhood of 9.5% by the end of 2022. Now that I've thoroughly bored all of you, let's get to some results. In the first scenario, where the Fed raises their rate by a minimum of 25 basis points, the Fed funds rate gets to 1.75% by December 2022. Based on historical correlations between the Fed fund rate and mortgage rates, this would lead to a projected 5% average 30-year mortgage rate by December 2022. And at this point, you may be asking, what will this do to home prices? And that is the right question to ask. A crash in the housing market will ultimately be a crash in home prices. I'm going to approach this from an affordability standpoint, which turns our question into how high can mortgage rates go until homes are so unaffordable that demand plummets and prices come crashing down, regardless of the tight supply. In this first scenario, once I plug in the mortgage rate along with some conservative projections for income and price growth, I find that the average housing payment in the U.S. reaches 37% of income, which gets us back to the previous peak of 36% back in the last housing bubble. So while this does put us into some unaffordable territory, this isn't going to be enough to crash the housing market by the end of 2022. Now for the second scenario, where the Fed gets a bit more aggressive and raises the Fed funds rate by 50 basis points in the remaining meetings in 2022, which would push the Fed funds rate up to 3.25% by the end of the year, which would correlate to a projected 5.6% average 30-year mortgage rate by the end of the year. Plugging these numbers into our affordability model, we see it would push the average housing payment to 39% of income by the end of the year, surpassing the peak in the most recent housing bubble. Now we're starting to get into the territory where home prices would simply have to come back down because so few people can afford them. Now it's worth noting here that 35% seems to be an upper bound on this metric. Not only did we see this in the previous housing bubble, but we see something similar back in the 1980s as well. Back in 1980, when I plug in the median home price, household income, and mortgage rate, I get a peak of 33% in April 1980, right in the neighborhood of where it went in the last housing bubble. So 35% is the upper bound we're going to consider for when prices have to start coming down. In the third scenario, which assumes the Fed would get as aggressive as they did in the 1980s to rein in inflation, we have a 150 basis point increase at each of the remaining 6 meetings. The Fed funds rate would reach 9.25% by December 2022, which would correlate to a projected 7.8% average 30-year mortgage rate. Now, if I just plug this into the affordability model without making any adjustments for prices, we see the average housing payment reaching 48%, which is way beyond the 35% upper bound we have seen historically. This is where we're getting into market crash territory. To find out where prices would have to go in order for the average housing payment to stay within historical bounds, I'm going to fix that percentage to 35% and calculate what the home price would have to be in order for that to happen, given that mortgage rates would be rising with other interest rates. Here's what that does to home prices. You can see it's pretty dramatic. If mortgage rates were to hit 7.8% due to the Fed having to get as aggressive as they did in the 1980s to fight inflation, the median home price would fall by a projected 28% year over year by December 2022. I call that a market crash. So there you have it, an answer to the question, when is the housing market going to crash? And the answer is that the market could crash by the end of 2022 if inflation remains as high as it is now and the Fed has to get as aggressive as they did back in the 1980s to bring it down. Keep in mind that this is the current scenario in which the housing market could crash, but a lot could change between now and December. The main indicators to watch are inflation, how the Fed reacts to inflation at each of their remaining 6 meetings in 2022, and how mortgage rates respond to what the Fed does. We also need to watch the real estate market data to see if there are any big swings in the supply or demand sides of the market, or if the federal government intervenes in markets in a significant way. So here's what I'm going to do. I will release a market crash scenario update video at least once a month, and we'll look at what happened with inflation, Fed funds rate, mortgage rates, housing supply, housing demand, and I'll run the numbers again to see where we are in the market crash scenario, if we're getting closer to it sooner or if conditions are pushing the crash date out further. You're going to want to make sure you're subscribed, hit that notification bell down below so you know right away when those scenario update videos come out. I'm not aware of anyone else on YouTube that is giving you this kind of analysis. How can I do this? I'm a professional economist with over 6 years of industry experience before I ventured out on my own and started this channel. My expertise is in macroeconomic forecasting, including real estate markets, and I accurately forecasted US GDP for a major Wall Street hedge fund manager in my days in consulting work. I'm also a licensed real estate agent in the state of California, so I know what it's like at the micro level too when it comes to the real estate market. I'm not telling you this to boost my ego. I'm telling you this so you know that I'm not just some random guy that's throwing darts at a calendar and making some fake graphs to get clicks on my videos. So please subscribe, hit that notification bell down below, share this video, give it a like, and help the channel grow. Your support is greatly appreciated. That way we can continue to bring you this kind of research to keep you up to date on the latest trends in the real estate market. If you're watching this on our Real Estate Watch channel, don't forget to check out our main channel, Papaya Cast, where we cover much more on the overall economy, such as where inflation is heading and how current events like the war in Ukraine are affecting the U.S. economy. We also have a video on why the heck the company's called Papaya Cast. Thanks for stopping by. I'll see you in the next video.